Hey guys, this is Will and Charlie from J. Charles Lending. We're going to go over a few data points here. We're going to talk about really the biggest subject right now, interest rates being high. We're going to go over a lot of different topics throughout the weeks that we do this, but we're going to talk about, if you're ready, willing, comfortable, and able, why you should buy right now, even with interest rates. But we're going to get into this in more detail. Before we do, let's get into why the rates are high and go into that in a little bit more detail. Charlie, go ahead and tell us why the interest rates are so high right now.
Yeah, I think that's a good baseline for us to have, is just knowing where they are right now, so that as we're looking at data moving forward in the future, we can make a good decision on when the right time is to buy, right? And of course, both of us think that we should buy right now anyway. If you're ready, willing, and able, it doesn't matter what the rates are, especially
Absolutely.
in our market, right? But real quick, real brief, there's two main reasons why rates are high right now. The first one's inflation. Inflation causes the cost of all goods and services to go up no matter what. And unfortunately, mortgages, even though it's not tangible, it's still a service. It's still technically a product. You're still buying money. Yep. You're buying something. And so the cost of that has gone up. We had super low inflation up until the beginning of 2021, like middle of 2021. Inflation started going up and started getting really bad towards the end of 2021. And so then it just finally hit. Unfortunately, that happened. And then the other part, so inflation always causes interest rates to fluctuate. That's throughout history. The other part that we need to really understand is the Federal Reserve was doing what they call quantitative easing during the middle part of the last decade. They were buying a lot of mortgage bonds to help keep interest rates low during like 2010 and on, after the financial crisis. So they started tapering that off, and they were tapering it off starting like 2018-ish, 2019. And so unfortunately, the tapering off, and they weren't buying as many bonds to keep rates low, and then inflation hit. And so it was a double whammy for all of our clients. And so last year, the first half of last year, rates shot up like faster than anything we've ever seen. So that's kind of our baseline. But that's the data points we really need to look at is moving forward, is inflation and like the strength of the economy and all that kind of good stuff as well, when we're really kind of determining where we think rates are going to go.
Okay. So we've been told that rates are going to possibly start coming down at the end of next year. Is that something that you see as likely, or what's your opinion on it?
I don't know. My gut feeling is telling me that we're going to be at this rate level for a little bit. That's just my gut. A lot of people at the beginning of this year, like thinking rates are going to come down at the end of this year, right? The last Fed meeting kind of updated those expectations to the end of next year. So I personally think that we're in an interest rate environment that we're going to be in for a little bit. Right?
Yeah, I completely agree with you.
I really think that we're going to see, if rates do start coming down, my gut's telling me they'll start coming down at the end of next year, or possibly in 2025. That's my gut feeling. I can't, tell you otherwise. But inflation is it's coming down, but it's still high, right? We're still seeing inflation, but it's based on last year's numbers when we had inflation of 8-9%, right?
Yeah.
So we're inflating off of last year's inflation.
Yep. So
we still have a ways
it's much
go
higher than
on
people
that.
think. When we get report of 3% inflation, year over year for, what was it, August, for one of the recent months, that's off of really high inflation. So,
right.
Yeah, that's, another thing to consider too is, if people are sitting on the sidelines saying, I'm going to wait till rates come down. Well, if rates start coming down, let's say they do start coming down at the end of next year, at what rate are they going to start coming down? Are they going to really be coming down at a half a point per meeting? Or are they going to be a quarter point and then 3 months later, another quarter point? And, my gut tells me it's going to be a slow path to getting back down to interest rates that people are probably sitting on the sidelines hoping to get. They may want to get at a certain rate, Now, what's that price? What's that rate that you're trying to get to? 5.5%.
Right.
And, that's you were talking about the strike price. If it gets down to 5.25, that's when I'm going to buy.
That's right. That's what I'm hitting.
What is that strike price that you're willing to take on a mortgage at a certain percentage rate? What is that percentage rate? And how long is it going to take to get there? So,
right, especially if we're talking about towards the last half of next year, and rates are still where they are right now, where we're seeing upper sevens in the eights, for conventional rates. Man, how long is it going to take to get down to 5, right?
Yeah.
So that's the golly. We can't tell. We don't know, but it's not going to just drop like a rock. Right. You're right. So how long are you willing to wait on the sidelines, not gaining equity, right?
Yeah. Not getting that appreciation.
Right.
And depending on your market, because this is so market specific, but I'm in North Houston area. Charlie, you're in San Antonio, so we're in very good appreciating markets that are strong markets. Really, we haven't seen a whole lot of pullback. I mean, really, the prices have, at least in the market here, stabilized. I mean, they're not really going down. Right. We're talking, if you want to sit on the sidelines, talking a few years, you're not getting that 3 to 7% appreciation per year. Yeah. I mean, that's powerful stuff. So,
right. Absolutely, 100%. Like, here's one of the things that we need to kind of talk about is one of the pieces of data that I researched now, and I was researching this last year for my realtor friends, right? So just wanted to throw that out there that I'm a year ahead of all these people saying buy now.
Yep.
Don't wait for the rates to come down.
I can attest to that.
Bit. Yeah. Because all my clients who bought last year, now they have another years of appreciation. But I did some research on this, and after the last financial crisis in 2007, 2008, the only state Texas outperformed out of all the large states. Texas grossly outperformed all the other states in the median home price. So, if we just take a baseline value, Texas stayed flat in value all the way from 2008 through about 2010 to 2011, right? And then started a slow, steady march up. We saw California, Arizona, Florida lose half of their value over those first few years. By like 2010, those states had lost half their value and then started to go back up. And then you pointed out too, when we were looking at this data, that the United States as a whole, on average, the average median price went down by 25% in the United States. And that's even with Texas kind of holding steady, right? And then it slowly went up. I bring this up just to show that with you and I being based in Texas, right? We are based here. Texas is going to be a strong market. So all of our friends and family, our realtor partners that work here, it's important to let clients know that Texas is an outperforming market. So whatever you see out there in the news on other states that are, going through tough times. So the market, our homes are going to keep appreciating. The houses that you are going to want to buy in 2 years if you wait that house is going to keep appreciating.
Yeah, absolutely. And the market data of migration into Texas supports that information. Yeah. So, I mean, we're getting too many companies moving here. You're bringing up the U-Haul information, the U-Haul report, which is a great report. It's fascinating. Yeah. But it does show that Texas, 6 of the last 7 years has been number one in migration.
Yeah, I think it was 5 of the last 7. It said U-Haul reports more people moving to Texas. Yeah.
Yeah, that's based on the one-ways from location A to Texas, as opposed to Texas to location B. So that's a pretty powerful report. It's pretty funny to type it in and say, hey, I need a one-way truck from Houston to Los Angeles and see what the price is, and do the vice versa. Right. It's significant. So It's a good way to tell if people are really moving there.
They're hoping that you'll take their truck back to
exactly
California or Chicago or something like that, right?
Yep. So I mean, it's another data point that suggests that people are moving to Texas so much that the home values are going to continue to increase year over year.
Right.
And we're seeing it even when there's supposed to be, some pullback because of interest rates, and we're not seeing it. So, if you're sitting on the sidelines and you want to wait a year, 2 years, 3 years for interest rates to go down, how fast are those rates going to go down? At what strike price are you going to be willing to take on that interest rate? And how many years of appreciation are you going to miss out on?
Right. What was the data you pulled on appreciation in Texas? Because you went all the way through the beginning of this year, right?
It was the last 10 years through, I think, the end of July of this year. And it was 214% at an annual clip of 5.5%, something to that effect. It was high.
It was the state of Texas.
State of Texas, yeah.
Right.
So it was the last 10 years, over 214% appreciation.
Wow.
I mean, that just, it's pretty powerful. So,
right.
How long are you going to sit on the sidelines?
Right. Well, the thing is, too, is so if you do, because the other part of it, and this is what a lot of people are saying, and it's 100% accurate, is if we're assuming a 5% appreciation rate on average for the state of Texas, right, then a $300,000 home will be worth $315,000 in a year, and then roughly $330,000, a little more, obviously. But we're talking about $30,000. By the time the rates start going down and we get to your strike price that you're talking about, where I'm going to buy when it hits 5.5% rates, right? Whenever that time is, how long are you willing to wait? Now the house is worth, now you get to buy it for $330,000, $340,000, whatever it is. Every $10,000 that you go up in monthly or in the balance of the loan, it costs you $70 per month on the monthly payment. So your rate is 2% lower than it would have been otherwise. And now my monthly payment is, it's $300 or $400 lower per month because of the lower interest rate. But you're also talking about it being $280, $300 more per month because of the higher loan amount.
Yeah.
So,
and you don't have the 2-3 years of pay down, principal pay down. There's a lot to factor in. So if you're spending $300 or $400 more a month in interest than you hoped or that you want to pay right now, well, you're getting that back in appreciation and principal pay down after 2-3 years anyways.
Right.
So, every situation's different. If you're ready, willing, able, if you like the house and you see yourself living there for a few years, or see yourself keeping the house for several years, whether it's you living there or you're going to rent it out in a few years, if it's something that you're comfortable with and you can afford it, don't let the interest rate stop you.
No, definitely not. We can have
that's
the
point.
Discussion.
Yeah.
We're here to advise, right? So
yeah, you just got to go through all the numbers, see what makes sense, and really add it all up. So
that's it. Right on.
Yeah, that's just something it's popping up everywhere. It seems like every podcast I listen to, it's the topic or it's part of it. Mm-hmm. A lot of people talk about it. Whenever I talk about real estate to people, every single person says, "Oh, interest rates are high." So it's something that we just want to get out there a little bit more for people to consider everything, because there's a lot more to real estate than just your monthly payment or the interest rate. There's a lot to consider. And this is a long-term investment. This is something that you should be really thinking about as a long-term investment. So the more people understand all the benefits of real estate and how powerful it can be for long-term wealth, interest rates are a factor, but it's not the ultimate deciding factor. So we just want to get everybody to be thinking about that more. And if anybody has any questions, please call us, message us. Tell us what we should name our podcast. Yes. Let us know.
We have no idea what to call this thing.
We're here to help. Yeah.
Yeah. So help us out also. Yeah. But right on. We're going to cover another topic next week. We'll probably build on this a little bit more as well. But thanks for listening. We'll see you all next time.
Thanks, guys.